Most traders believe their losses come from bad entries, but when you examine blown accounts closely, a different pattern appears. The entry was often correct, the analysis was often correct, yet the trade still collapsed. So the question becomes, if the idea was correct, what actually caused a loss? Consider a familiar situation. A trader enters a position. Price moves slightly against them. Nothing has changed in the market structure. The setup still looks valid, but something begins to change internally. Heart rate increases. Attention shifts from the chart to the floating loss. And at this moment, most traders make the same decision. You may already know what it is. They close the trade early. 10 minutes later, the market moves exactly in the original direction. The strategy did not fail. The analysis did not fail. The mistake happened after the trade was opened. And this is one of the most common patterns in trading. Correct idea, incorrect exposure. Most trading errors are not technical. They are pressure reactions created by a variable most traders underestimate: position size. Most traders believe position sizing exists to maximize profit. Professional traders use it for a completely different reason. They use it to prevent psychological mistakes. Look at the most common trading errors: closing trades early, moving stop losses, adding to losing trades, revenge trading after a loss. These behaviors rarely appear when position size is small. They appear when exposure becomes emotionally uncomfortable. You have probably experienced this pattern. A trader risks too much on one position. Price moves slightly against them. The setup still looks valid. Nothing in the market structure has changed, but something else changes. The mind stops analyzing the chart. Instead, it begins calculating money. How much will I lose if this stop is hit? Suddenly, the stop loss feels too far away. At that moment, most traders make the same decision. They exit the trade. Minutes later, the market reverses away from the direction of the stop. If this has happened to you, the mistake was not technical. It was biological. Under financial stress, the brain shifts from analytical thinking to threat response. Protection replaces logic. Instead of executing the plan, the mind tries to escape discomfort. This is why oversized positions quietly destroy otherwise good strategies. The market rarely defeats traders with complexity. It defeats them with pressure. Professionals control exposure. But position size alone is not the full story. There is a second pressure variable many traders ignore: time exposure. Consider 3 traders. A scalper holds a trade for 2 minutes. An intraday trader holds a trade for 2 hours. A swing trader holds a trade for 3 days. Each trader may risk the same percentage of capital, but the psychological load is completely different. The swing trader must tolerate overnight uncertainty, unexpected news events, weekend gaps, and long periods where nothing happens. Now something important begins to happen. The longer uncertainty lasts, the more the mind searches for control. This creates predictable interference, checking the chart constantly, closing the trade too early, reducing position size mid-trade, or abandoning the strategy entirely. If you have ever watched a good trade slowly turn into an early exit, you have experienced time pressure. Professional traders evaluate exposure differently. They understand that risk is not only price movement. Risk is also time under uncertainty. Ignoring time is one of the most common structural mistakes traders make. Now the pressure begins to escalate. When exposure becomes too large, The problem is no longer early exits, it becomes behavioral collapse. Many traders describe themselves as aggressive, but in most cases, aggression simply means oversized positions. Oversized positions create predictable emotional stages. After one losing trade, frustration appears. After 3 losses, hesitation appears. After 5 losses, discipline collapses. Revenge trading appears. Rules disappear. Strategy disappears. The trader is no longer executing a system. They are reacting to pain. Professional traders measure aggression differently. They ask a single question. Can I lose multiple trades in a row without changing my behavior? If the answer is no, the position size is already too large. This is where most traders make their final mistake. They increase position size before stability exists. Professional traders reverse this order. They scale size only after discipline is proven. Level 1, emotional instability. Risk, 0.25%. Goal, behavior training. Level 2, developing control. Risk, 0.5%. Goal, consistency. Level 3, proven stability. Risk, up to 1%. Goal, edge compounding. But very few traders reach this level. Most accounts fail because traders increase size before reaching stability. Risk must match discipline. Another common mistake is copying position sizing from traders with completely different styles. Scalpers may appear to use high leverage, but their exposure window is extremely short. High frequency, lower risk per trade. Intraday traders carry longer uncertainty, moderate exposure, balanced risk. Swing traders carry the longest uncertainty. They must tolerate overnight risk, news shocks, market gaps, long waiting periods, wide stops, long exposure. Many swing traders underestimate this pressure. They size positions too aggressively. Size for discipline, not profit. Professional trading firms teach a simple rule to junior traders. Before increasing position size, a trader must pass 3 tests. Can you hold a trade without constantly checking the chart? Can you lose today and execute normally tomorrow? Can you trade tomorrow normally? If the answer to any question is no, the position size is too large. Institutional traders understand something many retail traders miss. The market does not destroy accounts through bad strategies. It destroys them through unstable behavior under pressure. Trading success rarely comes from discovering the perfect strategy. It comes from maintaining stability long enough for probability to work. When exposure is calibrated correctly, the market loses its ability to intimidate. Because decisions stop being emotional reactions, they become execution. An execution without emotional distortion is the moment a trader stops behaving like the crowd and starts behaving like a professional. Most traders never reach that point, not because the strategy failed, but because the pressure was too large for the person executing it. If this shifted how you think about trading, the next principle will change how you manage risk entirely. Subscribe to continue the training.